Today, we're talking about my favorite subject in the world, and that is how to profit by understanding investor emotions. We're going to talk about the sentiment cycle, meaning how investors act during different points of a normal market cycle. Then we're going to talk about how to identify the two different types of investors, and that is smart money and dumb money. Ask yourself right now, do you want to be part of the smart money group or the dumb money group? I think I know the answer. So we're going to talk about identifying what those two groups are doing and following the smart money and staying away from what the dumb money is doing. We have 5 different indicators in this video that's going to help you understand where the opportunities of fear and greed by investors are happening. And then finally, I'm going to finish this video with my favorite fear and greed indicator that follows the market with very, very accurate signals. Well, as I noted a minute ago, my favorite topic in the world is sentiment trading, fear and greed. I just love this subject. In fact, I like it so much, I wrote a book on it. In fact, I honestly believe this is one of the best books written on that topic, which is extrapolating profits from dumb money moves and acting as a smart money investor on your own trades. So let's start off with the sentiment cycle. Now, you guys will remember if you've watched the first of my technical analysis basics videos, I talked about the 4 phases of the market. Well, those phases are explained by the sentiment cycle. Investors move from periods of extreme fear to extreme greed, and you can see on this chart here, when markets are going up, we usually move through a period of optimism, enthusiasm, exhilaration. As we make more and more money on the market, we get more and more optimistic. Who feels bad when they're making money on the market? And in fact, we become more and more excited and optimistic about the future of the market until the market hits a point of euphoria where nothing can go wrong. In fact, what's happening at that point is that investors, particularly dumb investors, have lost track of risk. They're starting to feel that there's very, very little risk on the market. And let me assure you, at all times, the market has risk. There is no period in time when there is no risk on the market. What's interesting is at market tops, almost nobody believes that there's true risk on the market, and they have projections of higher and higher returns looking forward. That's the point where we want to be looking at selling. Now, as the market begins to move down, investors move through a period of unease and denial and pessimism. These signals, or these attitudes, I should say, can be seen in the sentiment tools that I'm talking about in a few minutes. Eventually, investors begin to realize that they're in a lot of trouble because originally they're in denial and they just continue either buying or holding their stocks. They don't want to sell. They feel that things are going to turn around at any time. They're in complete denial. At some point, they reach the point of capitulation and then despair. And that's when dumb investors, the dumb money, throw the towel in. They actually sell near or at the bottom. In fact, in my career, I've been doing this for 35 years, and I remember at market bottoms, especially back in 2001, the tech bubble, I had a client that sold on the day of the hour of the market bottom. It was unbelievable. So this is a very, very common trait where investors are happy at the top and not so happy at the bottom. And we want to quantify the attitude through looking at data. The first concept I want you guys to understand is the concept of smart and dumb money. Now, smart money are institutions. They're usually huge commercial hedgers. They're institutional investors. They manage pensions. They're people like Warren Buffett. These people are data-driven. On the other hand, dumb money are usually retail investors that tend to make their decisions based on opinion or emotion. If smart money is buying and dumb money is selling, we have a pretty good idea that now might be the time to buy along with the smart money. However, in the opposite case, we'll sometimes see dumb money buying and smart money selling. That's a point where we may want to avoid the market. And at other times, they're both kind of moving together. So we're looking for the key points where they're moving in opposite directions, and this chart is going to help us do this. What we have here is the market pullback in 2022, and then the rally off of that from 2023 to 2025. And there were points along that journey where smart money and dumb money were moving in opposite directions. So when we have the ratio of smart money buying versus the dumb money not, we tend to move above this line right here. When dumb money is buying more than smart money, then the ratio will move below this line. So let's keep that in mind as we look back through history. Now, again, this is an indicator that will help us find key inflection points. So here we have the ratio of dumb money versus smart money moving very aggressively into stocks, and that is when the market made a bottom. So keep in mind, that means that smart money was buying and dumb money on a relative basis was not buying at the market bottom. Then when the market moved up, smart money began to move out of the trade. Now here we have another interesting inflection point because we have a point where smart money did not like the market at all, but dumb money liked it a lot. Take a look at where that happened, right at a market peak. So this is what tends to happen during any market trend, is that smart money moves in on the troughs and dumb money is buying on the peaks. Here we can see the same thing happening. During the bull market, after 2022's bear market ended, we had a number of different troughs where smart money was buying and dumb money was less interested. We then had market peaks where dumb money was buying and smart money was not. This happens over and over again. So it's a really interesting study and a really interesting concept to keep in mind. Now we're going to look at some indicators that will directly show you what those two specific groups are looking at. We're going to start off with a free tool that you can look at on the internet. It's the American Association of Individual Investors, AAII. And as I said, it's on the internet and the website is right here on this chart. Now, generally speaking, what I have found is that if we have about 60% of these investors who are generally retail investors, this is a large group of investors, of several thousand investors, who actually answer a survey periodically from AAII to tell AAII whether they're bullish, bearish, or neutral. If we have 60% of those retail investors in that very, very large sample size saying they are bullish, it tends to tell us that markets are overbought. If we have less than 30% of the respondents of this survey as bullish, that tends to tell us that markets are oversold. And the opposite is true as well. If we have too few bears, that means that markets are overbought. If we have too many bears, that means markets are oversold. Let's take a look at some history. Now, the average reading of market bulls using the AAII survey is around 37%. There's usually about 37% of their group of investors who are surveyed that are bullish, and there's about 31% that are bearish, and then the balance are neutral. Let's take a look at the AAII bear survey. Now remember, this is just isolating the number of bears that came out in this survey. What we found is that if the American Association of Individual Investors survey shows less than 22% bears, that can be considered too few bears. In other words, retail investors are too optimistic. Reverse is true as well. If there's over 46% bears, that tends to indicate that there's too many bears, and that usually indicates market bottoms. So let's take a look at that in action. I'm just going to focus on a few key points. Let's take a look at 2020. Do you remember what happened in 2020? The COVID crash, first quarter of the year. Well, lots and lots and lots of bears during that period. That was the perfect time to buy, and yet the average investor, the average retail investor, was bearish. Now, after that correction, the market moved into a bull market, and suddenly, about 3/4 of the way through the upside, we saw that their survey was showing too few bears. The bears were almost non-existent. Everybody wanted to buy stocks. This happened just before the market peak in late 21. Boom, down went the market. Now, when the market fell in 2022, look what happened. Tons of bears. Retail investors didn't like the market. Why did they not like the market when the market was down, but they loved it when the market was up? This is very typical. Now, what you'll notice on this chart is that these are leading indicators. They're not precisely pointing out that the market is time to sell or buy. What they're telling us ahead of time is that investors are either too bullish or too bearish, and we should take notice. Now let's take a look at the CNN Fear and Greed Index. It's a free tool on the internet. If you Google CNN Fear and Greed, you're going to come up to a site that will give you this tool. It's very simple. It's a compilation of different surveys and indicators like the VIX and put to call ratio and dumb money, smart money, and that kind of thing. And it puts it together and it gives you an overall reading of what retail investors are thinking about right now. And remember, we want to fade or do the opposite of retail investors, and we want to do what the smart money is doing. So this is telling us what dumb money is doing, and you want to only react when this indicator hits extremes. So let's take a look. This is the Fear and Greed Index, and as I said, it will move anywhere between a level of 0 to 100, where on the left side is extreme fear. That, believe it or not, is ideal timing for moving into the market. On the right side, we're getting into the green zone where there's extreme greed. That's when everybody's happy about the market. And again, being a contrarian indicator, that's telling us it's time to consider reducing our equity exposure. Now let's look at the CBOE put to call ratio. For those of you who don't know the difference in a put and a call, in essence, a put is bought by someone who is bearish. It actually goes up in value if the market goes down and vice versa. A call is bought by people who are bullish on a stock. I want to compare the ratio of puts to calls. And you can find this ratio in a lot of different charting packages, so it's not something that's unique to me. All I've done here is marked off on the chart areas that I have found in general indicate where people either are too bullish or too bearish. Now, obviously, if there's no fear on the market, nobody's buying puts. After all, nothing could go wrong. Why would I buy a put? That's what investors, retail investors, are asking themselves. So what I found is that if you have a ratio of 0.75 puts being bought for every one call that is being bought, that means that the market is complacent. Everybody's happy. Nobody feels that they have to buy puts because nothing could go wrong. Well, we tend to find that when there's a spike below 0.75, that tends to signify market bottoms. Let's take a look. Well, if we look in 2020, everybody was pretty happy coming into that point. We can also see in 2021, just before the 21 correction, people were again pretty complacent. We can go all through history here. In just coming into 2008, there was too much complacency before the market corrected. So it's a kind of a messy looking indicator. It's spiking up and down. But what I'm looking at with this indicator is if there's an extreme level in conjunction with some of the other stuff that we look at, such as trend and momentum indicators and even other sentiment indicators. It's a really good indicator even when we look at trends. I'm going to point out at the top here, this is when investors are becoming too fearful. They're buying too many puts. So this is a case of 1.25 puts bought for every one call. So people are buying puts. Why? Because they're fearful. And remember, puts make money because the market is going down, or they perceive the market will go down. And again, we'll find that at extremes. Right at the bottom of the 2022 correction, that's when everybody was buying puts. So you can see this indicator is a very, very good indicator for spotting key inflection points of fear and greed. Now we're going to talk about the VIX. Now the VIX is sometimes called the fear index, but really the proper term is volatility index. And what it does is it looks at the premiums that are charged on options. The bigger the premium, the more people think the market is going to move. So in essence, what we're looking for is again points of high premiums and low premiums outside of the normal range. So when we look at this indicator, this is going back to about 1990, and we can see when premiums are very, very high, that tends to mean that there's a lot of pessimism. So there's a lot of fear and there's a lot of premiums that are being commanded in options. 2009, right at the market bottom. 2020, during the COVID crash. All of these periods are periods when markets had made extreme bottoms and investors were demanding high premiums on their options because they were fearful of what's to come. Now we're going to look at extremes of confidence. When premiums are very, very low, that means investors feel confident about the market. Option writers are charging less because there's less to be worried about on the market. So we can see a great example here coming into the 2008 crash where premiums went very low. In other words, the VIX, or the fear level, was very, very complacent. And that gave us a signal that something was about to change. Same thing with 2017-18. Any of you remember in 2018, December, the market fell 25% in 1 month. Well, leading into that, we saw very, very low VIX premiums. So again, the VIX can indicate at extreme levels that markets are about to take a turn. Just to take another look at the VIX, we can use the VIX for short-term moves. So here again, I've drawn my extreme levels, but what I want you to notice here is that when markets are trending up, the VIX tends to be trending down. That's because people are getting more and more confident. When markets are trending down, the VIX tends to trend up because, again, investors are getting confident. Once in a while, you'll see the opposite, which is that instead of like here, where the market was moving up and the VIX was moving down, so here's the VIX moving down and the market moving up, in late 24, we saw the VIX begin to move up along with the market. And that usually indicates some sort of change is coming. So what I would anticipate is sometime in 2025 or on, you may see some sort of correction action. So I hope you enjoyed this video on sentiment trading. Now understand that all of these indicators are generally big picture indicators and they should not be traded on as an exclusive piece of data. In fact, I always encourage people to start with the trend and move down into momentum indicators, sentiment indicators, and other such tools. But by itself, these tools can be very, very valuable in giving us a heads up of changes in the market. The last one, as I said, the VIX was my favorite. I find that the VIX can be very, very telling, although it's a big leading indicator, but in many, many market tops and bottoms, the VIX can be very, very accurate in telling us what's about to happen. So, other questions, I'd encourage you to refer to my book on sentiment, Smart Money, Dumb Money, because I cover the indicators I've covered today, plus many, many more. Thanks for watching.